This is the video for Friday, April the 2nd. And I'm going to do two things today. I'm going to run through the things we normally run through, and then I'm going to show you the strategy that I've been employing for some time now, but particularly since February 24th, which marked the beginning of the correction in the market due to the coronavirus, and show you how that strategy has helped me minimize my losses. So the Dow and all the other markets took a little bit of a pop at the open, but only to the prior day's close, and then proceeded down. But it's the volume that we're looking at. And we're going to see when we look at our volume chart, up and down volume chart is particularly low. This should signal that we're coming to a bottom. Some are saying that we've seen the bottom. Goldman Sachs is saying we have not seen the bottom. Bank of America's expert is saying that we have seen the bottom. Advancers were behind decliners 3-1, so decliners over advancers 3-1. Here's some other statistics here. Look at the new lows. 357 new lows. Only 2% new highs. Only 8 stocks new highs in all of the stocks that they across all of these three markets. 93% of stocks were below the SMA, the 50 simple moving average. 91% of them are below the 200. This is just where people can click and say, I feel bullish, I feel bearish. This certainly is not indicative of what we're seeing in the rest of the market. And here's a very interesting article by McClellan. Take a look at this one, the surge in bearishness. This is worth a read. So there seems to be more bears now than there were the last time the market dropped, which was, we'll take a look at it. But when we see market drops, we see sudden bearishness. And when everybody's bearish, that's when the sentiment starts to turn and the smart people start buying, right? So let's look at our McClellan minus 39. So it's now down below the median. So chances are it's heading to an oversold situation, which is exactly what we'd like to see because it would coincide with doing a double bottom on our charts. Let's look at the volume the volume charts, up and down volume charts that we've been looking at now for about a week. And you can see that the volume of selling was quite high on Thursday, a little bit lower on Friday, but higher than it was on Tuesday and Monday. But still, overall, far less than what we were seeing in the rapid decline of the market initially. And I peg that as starting on February the 24th. Let's look at the charts. S&P still hanging on to, or just fallen out of this channel. I still feel we're heading for a W pattern, with this being the first wing. This is the top, and the second wing will come down into this area somewhere. The VIX dropped a little bit, so the fear index dropped. That's very interesting. Apple is looking just like the rest of the market. It took a bounce on Thursday off the top of the gap and managed to stay above that. That's a good sign. We want to look at Caterpillar. Caterpillar is not behaving in a W pattern like we saw with the market and with Apple. So that's interesting. Caterpillar, for some reason, is enjoying a bit of a resurgence. And it hit the top of the gap and dropped down, but kept the support of one of our green lines. So this green line right here, which was resistance and then support, 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 is now acting as support again today. Volume was a little bit low. Disney, I don't know how many families are going to be able to afford $1,000 to get into Disney. So I'm a little skeptical about how Disney is going to rebound from this. Coca-Cola, looking like a W pattern. Home Depot is the one that I'm really optimistic about. And it's found its top of its gap on Thursday as well, just like Apple, and bounced. It's behaving very much like Apple. I think Home Depot is an underappreciated stock. And my neighbor was at Lowe's today, which is just down the street, and apparently it's packed. People are buying garden vegetables, they're buying paint, they're working on stay-at-home projects. Um, so as long as those stores stay open, they're going to be sheltered from the worst of it. But what I wanted to touch on at the end is the strategy that I have for dividends. I keep a spreadsheet, and I've got it going back to 2010 of everything that I've done, all the buys, all the purchases, all the sales, all the dividends, any margin interest that I've paid. And this is showing the premium of short calls that I've collected as of February 4th, but from February 24th. So I'm taking only the weeks of February 24th onwards, and I've got a week in here called December 31st, and that accounts for all of the premium that I currently have open yet to collect. And I will have collected $41,000 in premium if everything goes as planned. So 7% of what I'm trading I've collected in premium. The S&P is down 23%, and I'm down 16%. So I have not, since February 24th, sold any stock. I have purchased stock to the point now where I'm roughly maybe 3 or 4% cash. And that's because I'm betting that we've seen the bottom of the market. And if we see anything lower, it's going to be temporary. But there will be a bounce back. So it's the premium that's helping me. If I take all of these out, and I want short calls. That's not the one I wanted to do. I wanted to take dates, and I want to just show you how much premium I have outstanding. $17,900 of premium still outstanding. And at the end of April, some of them will come to maturity, and I will then start putting in August, September, or October short calls, but I'm doing it at my cost. So sure, I could be collecting an awful lot more premium if I was doing near the money calls. So if Apple is trading at, what is Apple trading at? 241. If I were to put it at sell 250 calls, I would make a lot more premium. But instead, and that would be a short term, let's say the monthly 250s. But instead I decided to go out to the September, but I took the 300s and the 310s because that's what I paid for the stock. So if the market fully rebounds by September, which I don't think so, I will be whole on all of the stock that I've bought, but I'll still be able to keep all of the premium. So I'm keeping my risk to a minimum by making sure I don't get caught by a sudden reversal in the market, which takes my stock away from me because I've sold calls too close to the current trading price. Okay, let me repeat that. I purchased Apple in the 300s, the 310s. That's my average purchase price, but I've also bought some at 250, 240, 270 on the way down, but my average price is still 300 to 310. So those are the calls that I'm selling. September 300 calls, September 3 calls. For Caterpillar, my average cost is about $120. I'm selling, I think I've got August 120 short calls. So worst case is I make all my money back in a market that will reverse quickly, plus I get to keep the premium. But right now that premium is saving me from some of the bigger losses that the market is seeing, and I'm experiencing about a 7% cushion because I'm selling premium, but I'm not selling my stocks. If you have any questions, let me know, and let's see what happens tonight when the market's open. But expect a jittery to bad week if what they say in the next 2 weeks is supposed to come actually comes, which is a lot more people dying.